Should an early stage startup be doing M&A? Why? What's the rationale? Why spend $1 on M&A when you could be spending it on sales and marketing? It's far more predictable, right? Not really. We're going to do a case study in this episode on what good looks like. An early stage startup that's done not one, not two, but 4 transactions over an 18-month period of time. The why, the how, the financing. We're going to cover it in this episode of Inorganic. Let's go. Welcome back to the Inorganic Podcast. My name's Christian Hassold. I'm your host, and this is episode 22. The funny thing about this episode is I already recorded episode 23 2 or 3 weeks ago, and I have made so many cuts of this episode. This is like the 5th cut. Every single time it's getting a little better. So I'm really hope that this recording works out, because a lot of thought has gone to it. It's kind of like a complex topic, and it's also a complex company in that there's a lot of details underlying to sort of tell this story. But in this episode, what I wanted to do is a case study on what good looks like for an early stage startup doing M&A. And the subject of this startup is a company that has done not one, not two, but 4 acquisitions over the last 18 to 20 months. And it's really interesting to me as a case study because I think it is an example of how to get M&A right and why to do M&A. When I reached out to one of the company executives, as I was thinking about putting this together, I had asked them to come on and tell a little bit of the story of Chris, but they declined. They, funny enough, said that they didn't want the strategy of the company to become like public, or they didn't want to discuss the strategy in public. And I totally understand that. But I kind of chuckle because there's like 50 press releases on what this company does and the founders on podcasts and everything. So much love to you guys at Crisp, but your strategy is quite clear. And having been in the industry for a long time, that having that added level of subject matter expertise, I think it's pretty clear to unpack it. And I'm glad to have this opportunity to talk about what good M&A looks like in an early stage startup by profiling the company Crisp. So what we'll do in this episode is we'll talk about who the company is, what they do, and a little bit of background on the financing, which is really interesting. I think it speaks a bit to the maturity of the founder and the team having some credibility. And then we'll go into the acquisitions they've done. What kind of acquisitions? For what reasons can I surmise? I have an estimation of what they probably spent on each deal and what problems they were solving in doing so. And then maybe some learnings we can take away just as we're wrapping up. So with that, I'll start with kind of a problem statement, which is if you're a venture-backed SaaS company and you have $1 to spend, generally speaking, investors will expect you in the early stage to spend $2 or $3 to earn $1 of ARR. That $2 to $3 can be spent on sales and marketing and product. And as the company grows and scales to 25, 50, 100 million, the expectation is that you're spending closer and closer to $1 of investor cash for $1 of ARR to a point where you're getting profitable and the economics get even better. There's a school of thinking that existed some time ago where you shouldn't spend $1 of venture capital on M&A, but for really unique circumstances. However, we're in a climate that I think most recognize where sometimes M&A is actually a better investment. And people will say, well, 90% of M&A fails, so why would you spend $1 on M&A that's highly risky? I would say 90% of sales and marketing tactics don't always meet expectations of what their intended outcomes were. If you think about, identifying an ICP, developing the hooks and the lands and getting that product market fit, all of the things that are necessary in order to take that investment and turn it into a sale, into repeatable ARR revenue, there's actually a lot of risk on both sides. I've been in all kinds of SaaS companies where they're going through CROs, VPs of sales, they're changing team out, they're changing out the head of marketing because whatever their tactics and strategies are, they're not working as expected. So I think with that context, that will take you into, well, okay, if you're going to do M&A, what should it look like and why? So let's talk a little bit about the target company of interest for this episode, which is Crisp. Crisp is a company that was founded in 2016. It's based in Arkansas. I think it's outside of Bentonville. And the idea behind the company is really simple. You have to sort of understand the business problem to get it, which is if you're a brand manufacturer and you work with retailers like Walmart, Target, Costco, Kroger, Albertsons, what you need to understand is what are the inventory positions of your product in the retailer stores. You'd be surprised that you need the retailer systems to tell you that. What is the velocity of product moving through the stores? Through what channels did it sell? For example, if you sell to Target, Target can actually tell you what sold out of store, what sold through buy online, pick up in store, what sold through .com. You as a brand want to know all of that information so you can do a better job optimizing your product, optimizing your logistics and your supply chain so you can make sure you're the best partner to the retailer. And a lot of times that data is used to inform a lot of other bigger business decisions. The problem is, so you understand like what the brand is trying to solve is they just want data so they can make good decisions with their business. The problem is that every single retailer, be it a Target, a Walmart, an Amazon, they all store and share this data with brands in different ways. The systems are sometimes very antiquated using EDI or other file sharing technologies. Their taxonomy of the data is very different. The structure of the data is different. You may actually have to get inventory data from one system, sales data from another system. You really have to be very expert at each retailer in order to understand, in order to be able to get the data and put it somewhere where you can actually start looking at it and making sense of it with a data scientist. Ari Trasdal, the founder of Crisp, I don't know how he figured it out, but he figured out this is a real problem. And this is a real problem for a lot of reasons. One is, just have an efficient supply chain. Make sure that you have exactly the right product on the shelf, the right product in inventory in the DC, in the warehouse, and working with your partners so we have an efficient supply chain. Supply chains today are very inefficient, and we've seen that. And so Ari had a vision to start a company that did one simple thing, was create a standard library, a standard way to go get at this data retailer by retailer. So instead of brands having to have teams of people whose job it was to figure that out, they could put all their dollars towards the data science and the dashboarding and other analytics that were necessary to understand what was happening in a physical retailer store. And over time, we have seen, I think, that business sort of evolve from just being a source of data to, through its acquisitions and own product innovation, becoming sort of a storyteller of the data as well. So that's what Crisp does. And that is the problem that they solve. And the problem that they solve, I elaborate on because it will help understand a bit of their M&A. So I think the other thing important to share about this company is that Ari Trasdal, I hope I'm getting that name correctly, he is a founder, CEO with multiple successful exits. I think that's kind of a unique punctuation here, but one that teams should take in mind is you always want at least one person on the leadership team who is M&A experienced. And M&A experience is not one deal or two deals or being a part of a sale process. It is an executive who has led and been a part of multiple transactions through one means or another. Having that knowledge and that expertise on the team puts you in a position to be able to credibly run an M&A process and know the kind of resources and things you need to do to run that process. And I think in this case, Ari and a couple of other members of his leadership team have the right, seasoned experience to know how to do this in the right way. And that was kind of a precondition. Usually when I'm talking about SaaS startups in my other episodes, I'm speaking to what does good look like and how to think about and how to approach. What should you look for in a corp dev hire? What should leadership teams be thinking about in terms of M&A? So like a lot of SaaS companies traditionally will have founder CEOs who are really smart product people, but have never been around M&A. And so they need to go get those people. And so kind of bullet point one is having people there who have significant business experience and experience with M&A. Notably for Ari, he's got a great background. He's got more than 20 years of business experience. He founded Thumbplay, sold it to iHeartRadio, which was later acquired by Clear Channel. He founded TapPad, sold that to Telenor Group. TapPad was like a 6-year journey. He sold it in 2016. And then along the way, he made enough money to start Spring Capital, which is his own VC firm. And I think through being at the VC firm, he was around a lot of transactional experience thereabouts. And he started Crisp in 2016. So having context on the company and the founder and sort of the management team, I think is at least setting the table for there are some people in the room that knew what they were doing. This wasn't a luck shot. And that speaks to being intentional about how you structure or what people you have on your leadership team in carrying out a transaction. So one other thing I want to share about before I get into the deals is the company's pretty well capitalized. Ari founded the company. It looks like a seed round of about 10 million took place in January of 2016. Maybe that was some of his own money, friends and family money. In September 2019, they had another seed round of 14.2 million. In July 2020, they raised a Series A of 12.79 million. And then in April of 2023, they raised 35 million from 28 investors, which is crazy. It's what I read through all these raises, you'll see in February 2024, they got a debt facility of 30 million. In March 2024, they got a Series B extension of 52 million from 32 investors. And then it also looks like in September 2024, they raised 70 million from 37 investors. This is a little bit unusual, by the way. Like, not a lot of startups have this many investors in these rounds. But if you look at the investors, these aren't friends and families investors. These are actually very experienced investors. I have been looking at the investor cards here. Bill Wise, Com Ventures, Karsten Thoma. Karsten Thoma, for the record, is like a gangster investor from Munich. He famously was one of the founders of Endeca that sold to Oracle. He did very well in that transaction. It was like $1 billion sale. And he has ever since been spreading his investor dollars all over B2B. There's other professional firms in the mix as well. But it's kind of a long mix of really well-regarded investors who are in these pools. Nonetheless, it's a lot of money. And it's clearly, again, speaking to Ari's credibility in which he's able to raise these funds. The debt facility that took place in February 2024 is very interesting to me. I think that debt facility plays a little bit into potentially utilizing that as a backstop or using it as potential funds for M&A. Maybe. But in any event, we're establishing that by the time this company starts doing an M&A, which is in January of 2023, by that time, they've raised now almost 50 million. And by the time they do their second deal in October of 2023, they're still operating off of that 50 million. I think the debt facility may have come in a little bit sooner in order to finance one of these deals, is my guess, but I don't have the UCC filing, so it's a little bit of imperfect information. Anyway, the point is, well-capitalized company. Let's get into the deal. So there's 4 deals that take place. The first is a January 2023 deal, an acquisition of Integral Group, which is a Ontario, Canada-based company, which by my estimates was probably a $2 to $3 million business. I say that because of the number of people. It's roughly a 15 to 20 person company. They specialize in EDI integrations with retailers in Canada. And if I look at that deal, there's a few notable things. One, it's a small bite-sized deal. It's not a very big team. 2, it's probably a very reasonable deal in terms of price paid. It's a services business, so it's probably a 1x multiple. I would guess at most they spent $3 million on that company, if I'm guessing the revenues correctly. And what they got from that was subject matter expertise in EDI, which you desperately need doing what Crisp is doing. And they took a little time to ingest that business and bring it into the fold. And so that's deal one. Deal two is an October 2023 acquisition of Atlas Technologies. Now, this one is a very interesting one to punctuate on. Atlas was a roll-up of a lot of businesses. It wasn't doing very well. Its stock was lagging like sub $5 a share. Some new management came in and management said, we're going to start divesting assets. When a company that is in your ecosystem says they're divesting assets, your number one priority as a CEO, as a person in charge of corp dev, is to go figure out what they want to divest and see if any of those things are of interest to you. Somehow Ari got wind that Atlas was one of the things that they want to divest, and he figured out how to get that deal. It was a proprietary deal. There was no process that I heard of for this deal. Commerce, as you know, is my ecosystem. So this is a proprietary deal between Crisp and Advantage. And by my estimates, and it is a very rough estimate, Atlas is about a $10 million revenue company. It was more of a services company than a software company. And I wanted to really understand, what did Crisp pay for this company? I went through a lot of documents and materials to understand it. My best guess on the low end is they paid around $25 million for this company. So $25 million for $10 million in revenue, about 2.5 times. I could be off on the revenue. It may have been a little bit more, because 2.5 times would be high for a services business. So I'll take that as a possibility, but I'm more confident about the purchase price, because when I looked at the 10K for Advantage, the 10K for 2023 says that they had $21,108,000 in proceeds from divestitures. There was also a reserve for some holdback. And generally, an M&A transaction, there's upfront cash, there's some earnout or pay on over time consideration. It's even possible that Crisp offered some common stock as a part of the deal. So that's why I put in this 20 to 35 range. I think I'm closer to 25 million on this deal, which I think is a great purchase price for this company. And you're divesting it from a public company, so it's going to be super clean. Companies have all the books and records together. This company's been run really well. So it's a nice, easy deal to get done. I hope I'm not, someone will come back later and say, that was a really hard deal to do. Well, it may have been hard, but it's, should be pretty clean because it's a divestiture. Advantage wants to just move it out and focus on their core business, which is what they've publicly stated. So that's Atlas. And Atlas, for the record, is a company that's specialized in, one, getting the data from Walmart for their brand customers and then providing reports. And I understand that some of their technology was kind of pretty basic, but it was enough to hey, here are the problems that we need to solve for customers. And if you got the product team of Crisp together with the people at Atlas and put them in a room, you probably could have come up with some slick capabilities to provide to Crisp customers using that Atlas technology. So at that point, they've now done 2 acquisitions in 2023. They take a breath and they ingest these 2 businesses, and they then come back into May of 2024 and they do 2 acquisitions, 2 small acquisitions. The first one is a company called SetSite, which is a Minneapolis-based POS data company that is principally solved on providing access to Target and Walmart. People who do business with Target and Walmart, they're basically the data specialists for those retailers. So Crisp is getting subject matter expertise around Walmart and Target. Crisp SetSite's customers were brokers or agencies on behalf of brands, so they tend to work with smaller brands. Not clear to me, because Crisp principal customers are brands, whether those agencies become an extension of the SAM for Crisp, whether they start having these small agencies become customers, or whether they wanted the subject matter expertise around Target and Walmart. A win-win would be them figuring out how to make those small customers bigger customers, but the more likely possibility is that it's not worth their time and they decide that they just want to focus on the talent and capability. My best guess, again, SetSite, very similar to Integral Group, a 15 to 20 person company, probably 2 to 3 million in revenue. And my guess is it's probably around 1x purchase price. So A $3 million acquisition for roughly $3 million of revenue is what my guess is on that business. And it's a good win because what they're getting is at the top, subject matter expertise on the retailer, which is a product win. And two, subject matter as a people, and then probably some technological know-how in terms of technological capability specifically that helps integrate. Like you want the wires and the tech, whatever it may be, that you can then transpose to your scalable system that Crisp is building. So there's a product win there as well. The next acquisition that they made, which was basically a couple of weeks after SetSite, was Lumidata. Lumidata, another 15-person company in Minneapolis, also worked with Target and Walmart. The unique difference here is that they seem to be more of a reporting and insights company. So they took the data that came from retailers and they had a product called Solus, which provided insights and sales optimization for brands. And so this is like an ecosystem company living around all these retailers. That too was a company, as I mentioned, around that sort of 15-person size. Guess 2 to 3 million in revenue. Guess the purchase price of around 3 million is my best guess. The pattern that we're establishing here is that what Crisp is doing is they're making a choice of, instead of having to build their way into every retailer and have to hire people to go figure out how to get through retailer systems, how to work with those systems, how to pull reporting, they're buying these tiny little companies that live around these retailers. They're tucking in these companies, taking the people, the subject matter, the know-how, and some of the technological capabilities, folding them into product, and bringing the team in, and just really scaling the company efficiently in terms of product and know-how. The alternative solution is you don't do M&A and you just invest a bunch of dollars, one, in sales marketing to go get the customers that they might be acquiring, and two, investing a lot of money in hiring and training these people. Startups typically hire people out of college, so they might get them out of University of Arkansas, or they might get them out of some other university where there's a great technical program, but they don't have to pay top dollar for the technical know-how to reverse engineer and figure all these things out. It takes a lot of time. There's a lot of trial and error. So Crisp, if you look at the strategy, is acquiring the know-how and acquiring the capability, the technological capability. I know I've said that like 5 times now, but just kind of doubling down on what is happening here with the M&A. Okay, so now that we've looked at these 4 deals, let's talk about what you've actually gained. We've talked about the product, the subject matter expertise, the people, the customers. Let's talk about the money case, the money you're taking to the boardroom, the story that you're telling to investors. All told, I estimate, and it's a rough estimate, that they've acquired about 20 million in revenues. That 20 million in revenues is not going to turn into ARR by my guess. Some of these companies, they may have small customers they don't want. They may not want the customers at all. So let's discount 5 million and say that they've roughly acquired 15 million in ARR, if that's the case. They've paid, by my estimates, 35 to 40 million for that ARR. So here's what's happened. They've paid 2.3x for that ARR. And this company, because it's run really well, it's got a great story, it's growing at the right pace. I'm just going to assume everything under the roof is in good shape. That kind of SaaS company in this market is at a minimum going to be valued at 7x. And at a 7x valuation, take out the 2.3 of the 35, and what you have less is 4.7. That is your arbitrage. Arbitrage is the value that accreted the transaction, moving these companies from their table over to your table. And now you've added $70.5 million in value to your business by just getting this revenue under your hood and on your valuation scheme. This is a very, very smart way to do M&A. And if you think about what I said at the top is, if you're going to invest $1 in sales and marketing, or you're going to invest $1 in M&A, make sure that you're going to get the payback that you're looking for on that dollar spent in M&A. Setting aside execution of M&A, making sure that you integrate it in the right way and you do the PMI right. Make sure that you've got a really strong case for, wow, I could have spent $1 of this M&A on sales and marketing, and I probably would have gotten 30 cents to 50 cents back. I spent $1 in M&A and got $7 back. This is a great deal. And this is an example of what good looks like in M&A, not only from the kinds of deals you're doing and why you're doing the deals, but also what the economics look like and how the boardroom would receive this kind of news. If I'm this 30, 40 investors that are in this company, I'm thrilled with what's happening here so far. Now let's talk about what has to go right. The order of these deals is interesting to me. Post-merger integration is incredibly important. You have to get post-merger integration right when you're doing these kinds of deals. You can't slip up. And so you really have to wrap your arms around these acquired companies and aim for as close to 100% retention as possible. No, you can't have 3 CFOs, you can't have 3 CEOs, and maybe you don't need all the admin capability, but you make a best effort to keep everybody that you're acquiring that you absolutely need, and anybody who can't stay, you do right by them on the way out the door, one way or the other. And so the post-merger integration is really important. And if you look at the order of these deals, what I like about it is the first company they do in January 2023 is a 15-person company. That is the right number of people for your first deal. It's just enough that there's a little bit of complexity. It's just enough that you need to figure out how to retain everybody and get them excited about the business, but it's not too much that it strains your system. At the time they did this acquisition, Crisp themselves was about a 50 to 60 person company. So you're adding a material amount of people on that math. The second company, Atlas, was about 60 people or so. So the stakes were raised a little bit high. By that point, they've developed the muscle. They know what they need to do. And they're also dealing with a company that's been a part of a bigger company. So it's actually like, hey, this is really exciting. We're going to be a part of a completely different story. And it's something, Atlas was bought out of Advantage Solutions Group, and Advantage has been having a tough time. It's well reported in the news. So if I'm one of these Atlas people, I'm like thrilled I'm part of an exciting startup based in Arkansas that's solving this problem core to what we're doing versus all the noise and stuff that was going on inside of Advantage. So that must have been a really great win integration wise. And now they've got the muscle in place to go do the next round of deals. But notably, they spend almost a year before. What is it? They spend about 6 months before they go to do the next deal, which gives them enough time to ingest the acquisition and move on to the next. So going back to the top where I was talking about the text exchange with the executive, and they're saying we don't really want our strategy to be in the open. This is for you, my friend. I'm just being playful. Don't take this the wrong way. But I asked ChatGPT, what is GoCrisp's strategy? GoCrisp is their website URL. And ChatGPT said as follows. GoCrisp's business strategy focuses on helping consumer packaged goods brands and retailers optimize their supply chain through data unification, real-time analytics, and actionable insights. Crisp positions itself as a collaborative data platform, centralizing information from retailer and distribution partners such as Target, Walmart, and UNFI. By acquiring companies like Lumadata and SetSite, Crisp has expanded its capabilities into providing granular real-time performance data, which helps brands optimize inventory, reduce waste, and meet demand across both retailers and physical retailer chains. I love ChatGPT. It knows the strategy. So I would have loved to have Ari or one of his team members on the podcast to talk a little bit about the success that they've driven through M&A. But it's okay. ChatGPT stood in for you. The strategy is clear. I expect that this company's not done. As I mentioned earlier, they'll probably do a few more roll-ups to continue carrying the torch forward, maybe around grocery stores. They haven't done anything around Kroger or Albertsons or Aldi. So it's possible that these hundreds of agencies that do this kind of work may be the next targets for the business. That's my guess. ChatGPT thinks the same thing. So anyway, I hope this conversation was really helpful for founders and CEOs who are thinking about doing M&A, whether you should spend $1 in sales and marketing or $1 in M&A, and how to go about that thinking and what good looks like in terms of the kinds of acquisitions you do, the size, the shape, and getting the economics right. I think it was a great learning experience to share with all of you. If you enjoyed this conversation, please like, subscribe, share wherever you listen, and I'll see you on the next time of the Inorganic Podcast.